Welcome back to the New Financial World Powering Tomorrow podcast, the show where we break down how electricity, technology, and digital systems shape the real economy. I'm your host, Zakir, and today we're tackling a question that too often gets overlooked in conversations about digital assets, tokenization, new financial rails, and emerging investment trends. How does real money, fiduciary, and client-driven capital evaluate all of this? Not Twitter money, not venture hype, not retail speculation, real regulated capital. Because there's a big difference between something being exciting and something being investable, and the technology being ready for wealth management, long-term portfolios, and fiduciary responsibility. To explore that, I'm joined today by Mr. Michael Murray, a wealth management advisor, managing client portfolios across generations with a foundation in fiduciary discipline, risk management, and integrated planning. This isn't a crypto pitch. This is not a market prediction episode. It's a systems conversation. How do disciplined investors evaluate change? How do wealth managers separate signal from noise? And when new financial tools like digital assets, tokenization, stablecoins, and blockchain-based settlements start entering the conversation, what does the wealth management industry actually need to see before these ideas become usable? Mike, welcome to the show.
Yeah, thanks for having me.
No problem. I appreciate you being here today. But before we dive in, Mike, quick disclaimer for everybody. This show is for educational, informational, and entertainment purposes only. Nothing discussed should be considered financial, investment, legal, or tax advice. Always do your own research and consult a qualified professional before making decisions. All viewpoints expressed on this show are my own and are not of those of any employer or organization. Now we can get to it. So, Mike, I want to start this off with your foundation. Could you give us a little background on yourself before we go ahead and just dive into what you actually do on day to day? Give us a little background. Let the audience know who you are.
Yeah, sure. So I've been in the wealth management industry for over 25 years. I started my career with a couple of bigger institutional firms. Early on, I decided I wanted to get more into the asset management side of the business. So I went to University of South Carolina for undergrad. I went back to grad school at night at Johns Hopkins to get my MBA, and then ultimately did the Chartered Financial Analyst accreditation, which takes about 3 years to get that. I think most of the audience is probably familiar with CFPs, which is Certified Financial Planners. That's geared much more towards individuals and financial planning, and it's a great designation that everyone's familiar with. The CFA is a little bit more on the institutional asset management side. I spent some time at a small hedge fund, and most recently, I've been with a couple of large registered investment advisory firms. So, the difference with the registered investment advisory firms is that it's the fiduciaries. We've got to put clients' interest in front of our own. So we typically charge a flat fee for assets under management. We don't get paid for products or anything like that. So that's a little bit on my background.
Great. Thank you for that. Definitely. And Mike, I want to start at the foundation, right? So when people outside the industry hear wealth management, they often think it's about picking investments. But from what I understand, it's much broader than that. It's planning, it's risk management, taxes, estate strategy, client behavior, time horizons, and helping people avoid emotional decisions at the wrong time. So from your perspective, how does a wealth manager actually evaluate risk when looking at new ideas, new sectors, or new investment themes? How do you evaluate that?
Yeah, so you really kind of hit the nail on the head. I mean, we want to take a very broad picture with clients and make sure that number one, that their goals are realistic, that they've got enough money that's going to last them a lifetime, and spend a lot of time on financial planning as well as taxes. When it comes to the investment management process, for me, it's all about understanding and coming up with a valuation, right? So when we're dealing with individual stocks, we want to get an idea of what's the company worth, where is it trading today, and the idea is to stay diversified. So if people are out there doing it on their own, that's fine, and really you can take on more risk if you're doing it. But as an institutional asset manager, we've got to be cognizant of how we're positioned within sectors and make sure that we're diversified for clients.
And what separates something that's interesting from something that's actually investable?
Yeah. So for me, if you overlay the S&P 500 with a graph of the earnings for the S&P, ultimately earnings drive stock prices.
Gotcha.
And so it's not an exact correlation, but it's pretty darn close. And so for me, investing in a business, I want to make sure that they're free cash flow positive, that they have actual earnings so that we can come up with a range of what the business is worth. And so that means that there's a lot of other companies out there that haven't made a profit that will do very well. But there's also companies that aren't making money that you've just got additional risk. So when we're investing for clients, we want to make sure that we're investing in fundamentally sound businesses with good balance sheets, plenty of free cash flow, and a really good business model.
Okay. And how much of your job is math and models versus managing client psychology?
Yeah, so I spend a lot more time on the investment side. And so I would say it's about 50-50 for me. But most of the folks that, deal with clients directly, really it's a relationship business. And the most important part is having realistic expectations to make sure that clients are going to be okay throughout their lifetime. So that's the majority of it. The investment side of it, the day-to-day, but we're not active traders. We're going to let our investment thesis play out over time. And historically, that's how we've made the most money.
So majority long-term plays we're talking about.
Yeah, absolutely. And once again, there's a lot of different ways to make money in the stock market. And one way is not necessarily better. For me, I've got to be comfortable with my system, and that might be completely different than somebody else's. And that's okay, because I think the most important thing is that you've got to have risk management techniques in there. And then you've got to be comfortable with the risk that you're taking on and your strategy. So once again, for me, I want companies that actually have earnings, and in particular, free cash flow is really the most important metric. When I'm looking at a business, I'm always going to adjust earnings, right? So you take a look at bottom line earnings, you add in depreciation because it's a non-cash charge, and then you take out CapEx, and that's kind of adjusted earnings. And just a kind of a basic example, let's say you had a lemonade stand, right? And you got $1,000 in revenue, and you had cost of goods sold of $400. And let's say you buy a new juicer and a table, and that's $200. Free cash flow would be your revenues, 1,000, right? Minus the $600, right? That you spent for cost of goods sold, $200 for the juicer, you made $400. For me, that's more important than earnings. If you looked at the earnings in that scenario, right? Let's say you got $1,000 in revenue, cost of goods sold $400. If you looked at earnings and you spent $200 on, let's say, a juicer and table, you would depreciate that potentially over the next 20 years, right? So
Gotcha.
let's say you'd have a $10 depreciation charge in there, which is non-cash. So earnings would actually look like you earned $590 versus free cash flow of 400. So then you can put multiples on that, whether it's a capital intensive business or whether it's not a capital intensive business, and that's where I'm talking about coming up with valuation. And then you've got to look at what are the realistic expectations for the next few years. I think people can get into scenarios where you're projecting 25 years into the future, and it's just not realistic, right? So
Mm-hmm.
I can get a pretty good feel for what's going to happen over the next 3 years, 5 years. And I just put a multiple on that. That's how I'm comfortable. But somebody else might have a trading system. They're strictly looking at technicals. And once again, that's fine. You just have to have a system that you're comfortable with, that you can stick to, that works for you.
Gotcha. And do clients really do they tend to overestimate the upside of everything and underestimate the timing?
It really depends. For us, once again, having a long-term investment strategy has worked best for me. And so by doing, like I said, by focusing on companies that actually have earnings, it's been successful. And there's going to be volatility in the market. And so you've got to be able to stick with it. Obviously, Nobody minds upside volatility. I haven't ever had anybody say, you know what, I made too much money this month. Man, I can't handle that volatility. It's when things go south, right? And that's where
Yeah.
you got to have either a money management system in place, or you got to be confident enough in the underlying businesses that you own that you can stick with it. And then once again, from a institutional asset management perspective, you just want to make sure that clients are positioned based on their risk tolerance. So, you know, a lot of people will focus on age. And I think, that's one way to look at it. But, you could have somebody who's really aggressive that's in their 70s. It can handle volatility much more than somebody that's in their 40s. And so
Hmm.
really it's got to be tailored to that person because, we haven't seen a significant pullback in the last couple of years. And so we've just seen, asset values continue to go up and it's easy to hold on then, but you really need to just be positioned for volatility so that you don't want to sell out when things are already depressed. You need to take that into account.
Okay. One thing I think everyday investors struggle with is that a trend can be real, but it can still not be easy to invest in responsibly, right? So when a major trend develops, how do you think about turning that theme into a responsible allocation?
Yeah. So for us, once again, it comes down, or for me, it comes down really to valuation. So when it comes to digital currencies, for instance, right? I don't know if Bitcoin's worth $100,000 or if it's worth $1 or if it's worth 50,000. That's not to say that you shouldn't invest in it. It's just that for me, I can't come up with a valuation there. So for us, if somebody's going to invest in these assets, they just need to have a plan or a strategy. So if it's 5 or 10% of their overall account, that's fine. And in my opinion, you don't want to put too much money into something with that much volatility unless you're comfortable with it, right? And then I think
Okay.
there is I think there needs to be some differentiation between, your long-term money, whether it's your 401k or whatever your retirement is versus
Mhm.
a shorter term trading account. So once again, we tend to be dealing with clients' longer term asset portfolios. And once again, by focusing on valuation and that kind of being the determining factor for me when it comes to individual businesses versus trying to spot a trend and jump on it, that's just how I approach it. But once again, there's a lot of different ways to do this. It's a big market, a lot of different ways to make money. Um, I think the biggest thing is that you've got a strategy that you're comfortable with, that you can stick to. Or for me, it always goes back to what do I think the business is actually worth based on adjusted earnings? And I'm not talking about a specific number, right? $57.25. And come up with a reasonable range on what I think a business is worth and then where's it trading? Is it way in front of what I think the valuation is? Well, at that point, we're probably going to want to trim it. Or if it's significantly undervalued, then I'm more comfortable investing in it. So that tends to be much more of a driver than just simply looking at a chart for me. But once again, I'm not saying that people don't make money using technical analysis because they absolutely do and can. It's just, once again, that's not my strategy. And I think that it just goes back to you've got to be comfortable with how you're investing and have a plan, right? So
Gotcha.
that you know what you're going to do if and when you hit volatility, whether it's adding to a position, whether it's selling it. And so for me, once again, we want to stay diversified within the various sectors of the S&P and not get all of our eggs in one basket.
And that was leading actually to my next question I wanted to ask you was how do wealth managers evaluate a theme that belongs in their portfolio or not? And what vehicle makes up for that exposure?
Yeah, I think it depends on the advisory firm, right? There's so many tools out there now. You've got exchange traded funds that are well diversified that are tied to the S&P or other indices. And then you've got individual stocks, right? That are individual companies and individual businesses. So the wealth management space, there's a lot of people doing a lot of different things within the space, steered more towards owning individual businesses. Because once again, I can evaluate what the balance sheet looks like, how much we think the business is worth versus where it's trading. And when it comes to sectors, we want to have exposure to really most all the sectors. There's some smaller ones that are out there, materials, et cetera, that we might not have any exposure within some of the smaller sectors. But there's a lot of different ways to get exposure, whether it's through exchange traded funds, ETFs. It really just comes down to the individual firm and how they want to be positioned.
Gotcha. And well, I don't want to get off subject, but that's kind of where I was this year so far when it comes to seeing the S&P, like the whole stock market. Well, we hit it all-time new highs again, and it's just the fact that when the war hit, you could look at the charts, you seen how everything started to fall a little bit, right? And then how gas jumped up. It was like the opposite. The oil stocks shot up. A lot of the other assets shot down. And then you also seen, which was interesting, gold start to go down, silver start to go down, which I mean, from what I've seen before, is that usually when there's uncertainty that starts to happen in the market, usually people go to gold. Usually people go to precious metals and things like that, but it didn't happen. So now I mean, this is my opinion. I don't know if I'm correct or not, but it just seems like it's more people holding on to cash right now.
Yeah, and it's interesting when you talk about gold, right? So I've had exposure to gold. The initial thesis was, typically gold does well in inflationary times, right? And it's typically not correlated with the dollar. Well, when I first
Exactly.
bought into gold, that thesis, we had inflation going higher. Gold didn't do anything for like 2 years. And so you got to reevaluate the thesis. Has it changed now that gold isn't necessarily as correlated as it used to be to these things? And then ultimately, as things played out, gold really had a huge run. You saw silver with a massive run at the beginning of this year. So I think some of that was just from a pricing component where you saw that pullback because you just saw the massive runs in both. And I think that's what it gets back to. And I think you've got obviously a lot more expertise within the crypto space, but that's the other thing when it comes to some of the cryptocurrency. I think some of the thesis a while ago was these things are going to act more like gold, more like a hedge. And really, you've seen price volatility and maybe not the correlation that people anticipated. But once again, these things play out over a longer period of time. So it's interesting. I think sometimes when you see big swings in the market, sometimes it's naturally going to be there's going to be a pullback. We became concerned about 18 months ago with the tariffs, right? Because that could ultimately have an impact on the businesses and what their earnings are. But I think we're living in an environment where you're also seeing a lot of headlines and things can change very, very quickly. And that's why it's even more important to really have a plan because, things can change on a tweet. You just never know. You never know what's going to happen. And so with the war, you saw, like you said, you saw the big rally in oil companies. So for me, looking at the oil companies, right, I think the big integrated, right? And I know we can't talk about specific companies. So if you look at those businesses, they should be able to compound earnings, probably in that 10 to 12% range. So even if you see a big move up in price, I think over time, the earnings are going to be continue to be pretty strong versus, some of it is tied just to the price of oil. I've been doing this 25 years. I really do think you're seeing more and more daily volatility than you've historically seen. So we're seeing some pretty massive price shifts and you're seeing returns concentrated into shorter periods of time, right? So all of a sudden you got a business that hasn't done anything. And then all of a sudden you see in a very short period of time, a lot of compounding happening. So once again, I think that's just kind of goes back to having a strategy and having a plan.
Now I want to move into the phrase new financial rails. I use that phrase a lot on this show, but I don't just mean crypto prices. I mean the plumbing underneath finance, period. The systems that move value behind the scenes. So when you hear terms like blockchain, tokenization, digital settlement, or new financial rails, how do you interpret that from a wealth management perspective?
Yeah, I mean, we've seen a dramatic shift over the last 25 years, right? When I started, stocks were still trading in the fractions, right? So we're looking at eighths and sixteenths. And then ultimately you saw that go to decimalization and you had 3 day settlement. And now, you've now settlements within a day. And I think really what it seems like we're heading towards is probably 24-hour trading. And that's where that technology and plumbing really comes into it. The other thing is, you know, it used to cost money to trade stocks. and that then it came down to 495. When I started in the business, they could cost you $100 to trade stocks. So what we've seen
Wow.
is that's come all the way down essentially to zero, right? And I think that's the plumbing. And once again, we're seeing decimalization. We're going to see we've already seen it. We've seen settlements go from 3 days down to 1 day, which maybe that just happens instantaneously. So that's where we're seeing a massive shift in the technology that kind of impacts the industry.
Do you see modernization of settlement, custody, or payments as genuine innovation, or still too early to know exactly who survives?
Yeah, I think there's definitely a lot of innovation around it. I think what some of the firms have run into now that trading doesn't cost anything is they're trying to figure out, well, how are we going to replace that revenue, right? And so are they going to do that on the money market side, et cetera? Because there is a cost for them as far as doing business. I think with the blockchain technology, things are getting more and more secure, but then you're dealing with AI and multi-factor authentication that now
Hmm.
AI has started to figure out. So, the technology moves faster, I think, on both sides. So it's going to be interesting to see ultimately, how.
What would you need to happen for tokenized assets to be treated as operational value or operational viable within traditional portfolios?
Yes, I'll be honest, I'm not as familiar with it, right? I think there's a lot of that potential around like money markets and things like that. So, or for me, really, it would just be the availability for clients. At the end of the day, we're trying to make sure that we're taking care of people as best we can. And so, if it makes sense from a structural standpoint and the returns make sense, and obviously we would include that. We just got to make sure from a regulatory perspective. I think the great thing is that there's so many new avenues available for people to gain access, right? So if there's an idea out there, there's somewhere that you want to put your capital to work, I think there's a ton of ways that you can get access to it, which is great now. Before, I think the barriers were much more significant, where, what you're seeing is that if there's an investment opportunity that you want to take advantage of, then there's a way for you to get access to it.
Yeah, and I talk about this in my book when I'm trying to refer to the accessibility when it comes to digital assets. And they're saying since the stablecoins are going to bring a lot more opportunity for people that don't have the opportunity to actually hold the dollar, a physical dollar themselves, now all you need is a phone, and now you have that ability to own a digital dollar, which is the same 1-to-1 ratio USD coin to USDC or USDT to the dollar is one. It was supposed to be 1-to-1, but it's still I think it's still some blocks there because you're still going to have to own an account, an HCH account. You're still going to have to go to the bank and be able to deposit certain money in there. But if you don't have a bank, then that's still there's your gap between how to actually purchase that actual digital asset. So I totally understand what you're saying when you're saying the opportunities are there, but there are still going to be gaps. I mean, because you can have a phone all you want to, but if you don't own a bank account, you don't have any on or off ramping onto the rails to actually own it. So there's your gap. Now, for themes like AI or grid modernization, which I know your background is in electrical, but I mean, it's still in an the grid still brings investment opportunities, right? So
Yes.
exposure often starts with public market proxies and private funds. How might tokenized vehicles eventually complement or even shortcut those traditional pathways?
So, you brought up a couple of big themes, right? That's out there,
Okay.
right? As far as AI, you brought up power infrastructure. So, it's interesting if you look at even kind of boring utilities, what you see is that power consumption across the country is going up, which it was really stable for a long period of time. So
Yeah.
you're looking at utility companies, and most people, obviously, you gotta pay your phone bill, you gotta pay your utility bill. So what we've seen is that power consumption has gone up. I think then you've got to take a look at, well, what multiple have they historically traded at, right? Is it at 10 times earnings? And now what you're seeing is that if now power consumption has gone up, really should it trade at 12 or 13 times earnings, because what you're seeing is that the fundamentals, the underlying business, now you're seeing earnings growth that you hadn't seen previously. I think one of the other things with the utilities, just that, people need to keep in mind is, it is important the regulatory environment that the utility is in. There's a cost of capital associated with all these projects. And so you want
Exactly.
to make sure that they're going to be able to recoup their cost of capital. Once again, for me, I want to own businesses that currently make money. That's not necessarily for everybody, because there's some very interesting technology that I'm sure you've covered, right? With some of the nuclear technology and some of these things going into data centers, they're a long way from profitability. But there's going to be some big winners probably within that space and some big losers. Now, for me, that's too much risk, and I don't have enough insight to determine ultimately who's going to be the winner, who's going to be the loser. But if we go into regulated utilities where power consumption is going up, you're seeing earnings growth really almost double digits in some of these, which historically you didn't see. So that's an investment trend. AI, it's going to be interesting to see how it ultimately plays out and the impact that it's going to have on jobs. Large language models have done great as far as note taking and some other things from a technology perspective. Haven't historically done as great on the portfolio management side, but you've got to assume that all of these things are coming. And so it's just going to be really interesting to see how it plays out. So, they're kind of boring ideas, but I would be playing those within the space where companies have actual earnings, whether it's a chip company that you're seeing get adopted more and more into all of these data centers. That's how I would play it, but you might play it differently because you've got different insights into an individual company that doesn't make any money right now, or that's a new IPO. There's not one way to do this. And I certainly don't say, hey, this is my way, so everyone should do it that way. It's
Hmm.
just my comfort level is if I know a company's got earnings, I can come up with what do I think it's worth? And then I can go from there. But there's no doubt that AI is going to have a huge impact on our lives going forward. And so it's definitely coming within the financial space too. It's just going to be interesting to see how it ultimately plays out.
Thank you for that, Mike. That was great. Thank you. And now I want to bring digital assets directly into the conversation. But I want to be careful about how I frame it, all right?
Okay.
This is not about asking whether Bitcoin is going to go up or down. This is not about meme coins. This is not about hype, period, okay? I just want to ask I want to ask from the wealth management side, from a fiduciary standpoint, what hurdles must digital assets clear before they can be considered viable portfolio components?
Well, so, you know, once again, you're going to get a lot of different opinions within the space. So there's no doubt that there's a lot of firms out there that are actively investing in digital assets and crypto, and you can gain access through exchange traded funds, mutual funds directly on the platform. So there's a lot of different ways. It's already out there. I think there's plenty of investment firms, registered advisory firms, et cetera, that are actively participating within the space. And so I think the barriers are already down. It then comes down to what is your investment thesis and ultimately whether or not you want to be within that space. And so for me, once again, I just am not familiar enough with it or comfortable to say, this is what I think it's worth. This is where I'm going to buy into whatever the digital asset is. There's a lot of other people, and you're one of them that has spent a lot of time studying that, right? So that know a lot more about it, and then you can determine, hey, this is what I think, and this is where I'm going. There are a lot of institutions out there within the space because we're seeing a lot of different ways to gain exposure. And so I think it's already cleared all of those hurdles. It's certainly becoming much more mainstream. I'm the old guy, not investing in it, but at the same time, I think that there's a lot of different ways to access it, and there's a lot of firms that are accessing it.
Are there certain risks that remain unresolved for you?
I think it's really just comes down to I don't know what it's actually worth versus where it's trading. So, you hear projections on and just Bitcoin, right? And
Hmm.
I understand that, there's going to be a maximum number that are going to be issued, but things change. So maybe that changes down the road. And once again, maybe it's worth 10 times where it is today. If it's ultimately the value is through exchange for goods, then I've got to figure out, is it worth 50,000 or is it worth 100,000 or is it just worth $1? If you also have these coins that are coming that are dollar for dollar. Once again, I think it just comes down to people need to do their research. They need to be comfortable with how they're investing. And that's the most important thing, because if you want access, that's the great thing now. You can get access to pretty much anything that's out there, as long as you got a bank account and a phone.
You're dropping jewels on people right now. I hope they're understanding that you're dropping priceless jewels right now.
Yeah, right.
What is the simplest way you describe Bitcoin to a client then? If they were asking, "Hey, I want to buy Bitcoin. I want some digital assets." What would be how you would
Yeah,
describe it to them? How you break it down?
sure. So one, I think with anything, you've got to be upfront honest with somebody, right? So no problem saying, I can't figure out what it's worth. Having said that, if that's something that you want exposure to, at this point, we're saying, keep that to a 5 to 10% position of your overall portfolio, unless, they've got particular insights. At the end of the day, whether it's investment management or whatever the business is in, you know, for the investment management business, you're managing assets for a client. And so at the end of the day, it's their money. And so I would caution somebody, don't get too concentrated in any one position, whether it's an individual stock, an individual bond, an individual cryptocurrency. So if it's 5 to 10% max of a portfolio, I think that's a reasonable amount. Anything over that, really your performance is going to depend on that particular asset. And so once again, you just have to be comfortable with that. So for me, no more than 5 to 10% in any one particular asset, whether it's an individual stock, an individual bond. I think that's where you get diversification. But if somebody feels comfortable with the volatility, and that's the other thing that's great, right?
Mhm.
Individuals now have access to all of these things. And so institutional investors are going to be more constrained. At the end of the day, if you're a fiduciary, right, you've got to answer to regulators on why you did something for a client account in particular. Once again, if they lose money, right, you're gonna have to explain what you were doing and why you were doing it. As an
Gotcha.
individual, if you think you've got an advantage, you can go out there and take advantage of it, because at the end of the day, it's on you, right? So if you do really, really well, that's on you. If you get burned, that's on you. When you're managing investments or anything for someone else and you're their fiduciary, you've got to answer to them, but then you've also got to answer on why you did something in an account. And so that's where it comes into more diversification. That's why that 5 to 10% range makes the most sense to me.
Thanks for that, Mike. That was great. I want to zoom out and bring this back to the bigger theme of the new financial world. We've talked about financial rails, we've talked about digital assets, and we've talked about tokenization. We've talked about the movement of money becoming faster and more programmable. But all of these systems, AI, blockchain, real time settlement, data centers, and digital finance ultimately depend on a very physical foundation. So, Mike, from a wealth management and capital allocation perspective, how are disciplined investors thinking about these physical supply side constraints?
Yeah, I guess I'm boring like the same answers over and over. But for me, it really does come down to the individual business, right?
Yeah,
And how much do I think the business is worth versus where it's trading, and then staying diversified for sure makes the most sense. When you talk about specific inputs and things like that, I think that's all part of the big picture when you're evaluating the business. Where are they ultimately going to be constrained potentially? What
hmm
do you think they're going to do with earnings over the next 2 to 3 years? Once again, you can fall into, I think it's a trap where you're trying to project 25 years out into the future and nobody knows what's going to happen there. For me, it's really looking at individual business components and, trying to figure out what it's worth.
Yeah, and I think that's why a lot of people get scared of the nuclear investments because of the regulatory red tape that takes such a long time to even see ROI on that investment. So it scares a lot of people from investing in nuclear, even though to me, I think if we are moving towards a 24/7 always on digital infrastructure, you have an always on power source that never turns off as well. That seems to be a great match to me. If we're trying to go to this always on system that we're trying to implement now.
They're talking about having smaller nuclear
Yep.
support the grid with these data centers that are requiring so much energy that I think once again there's going to be players within that space that ultimately work out very, very well. But like you
Hmm.
said, the ROI and getting that return on an investment is going to take many, many years. And so that's where it just becomes difficult to come up with a valuation today on some of those
Hmm.
firms. It seems like the technology has arrived and the grid is stressed. So you're starting to see that deployed, and it's a very compelling. I think it's very compelling and very necessary. It's just going to be interesting to see ultimately where the winners are. This is going to take place over, like you said. I mean, it's expensive on the front end, and these
Hmm.
businesses don't have earnings, but ultimately, power consumption, we need more of it for sure. With these data centers getting built out, it seems like nuclear now is in much smaller packages too. So you would think that ultimately there's going to be some winners within that space.
Yeah, I think the first, don't quote me on this, Mike, but if I'm not mistaken, I think the first SMR, the small modular reactor, goes into effect 2027, if I'm not mistaken, in America. I think Russia has some already, but if I'm not mistaken, I think America's 2027. Next year will be our first year with one actually running. So we'll get some data on it here soon. I think this is where the power conversation gets bigger than cost. A lot of people think about electricity as just an expense, but for digital finance, AI, data centers, and tokenization systems, electricity is more than just a cost input. It's reliability input. If power is unstable, if a data center loses uptime, if a grid stress affects compute infrastructure, then the financial system built on top of that infrastructure can face real operational risk. So, from a capital allocation perspective, when you look at digital infrastructure, do you think investors should evaluate power reliability and infrastructure resilience as part of the um, profile, not just how much the power costs, but can the
Yeah, no,
system stay online?
it's an interesting question because, like you said, I mean, at the end of the day, that's the most important thing for these systems, right? We
Exactly.
need, we need power, and if there's not power, it's all going to go down. So, from your perspective, how real do you think that threat is as far as power is concerned at this point with all the stress, on the grids out there?
It's a great question. I didn't study for the test. mean, um, I think the threat is very real to a certain extent. We're just lucky with our power situation that we have where we live. I mean, instead of rolling blackouts, we see higher bills. I won't I'm not gonna go into all the details of why that matters. I mean, I do have. I'm not saying that I don't want to. It's just more of I don't want to take too much more of the show. I do explain a lot of it in one of my earlier episodes, but I don't think it's an automatic collapse. I think it depends on planning, the sequencing, and who pays for those upgrades. The grid can handle the growth when load is added responsibly, but the problem is when massive AI data centers or hyperscalers show up faster than a utility can build generation for the transmission, the substations, and the protection systems and the interconnection upgrades that it needs. That's when the stress actually becomes real. So to me, the biggest issue isn't just power generation; it's timing. Are these projects being sequenced in ways the grid can actually absorb it? That's why I actually like the way Florida's looking at it, because if I'm not mistaken, I saw when they were talking about how when large load customers now may have to contribute to the upgrades that they're asking for, because if hyperscalers need new transmission, substation capacity, and protections, that cost shouldn't automatically land on households or small businesses. And that's when you also have to look at the 24/7 issue when it comes to AI infrastructure and digital assets. They don't run when the sun only shines or when the wind only blows. These systems need firm, reliable power around the clock. So, yes, solar and wind and batteries and natural gas, coal, nuclear, and distributed energy all play a role. But we have to be honest about what each resource can and cannot do. My view is nuclear has a strong case here because it provides a firm baseload power that matches the always on nature of digital infrastructure. Natural gas still matters for flexibility, renewables and storage matter for capacity and cost control, but the mistake would be pretending one resource solves everything. So, yes, the threat is real, but it's not just a generation threat. It's a coordination threat. If utilities, regulators, and hyperscalers and grid planners move in the right order and allocate costs fairly, yeah, this can be managed.
Yeah, and I think with any time that you invest, right, in anything, there are a lot of things that potentially could go wrong, right? But that's part of the risk that you take on by investing. So we're going to have these black swan events that occur, and you can't take that into account for everything that you're doing on the front end because there's going to be some things that go wrong. And so I think right or wrong, let's say, for instance, if you're investing in a utility, yeah, there could be a situation where the utility fails and all these things go wrong. But if that is your thesis and that's what's driving your investment, I don't think you'd put much of your capital to work ever, right? Because I think you've got to go with what's the base case scenario? Where are earnings? Where do I think they're headed? What do I think it's worth today? Knowing that obviously, if for some reason, whether it's a particular utility, their grid goes down and there's massive outages, well, that's going to show up for sure and it's going to hurt your investment. But I don't think you you can't let that dictate your investment thesis on the front end because I think otherwise you just keep all your money in the
Yeah,
bank account because there's going to
gotcha.
be events that are out there that could certainly have an outsized impact. But at the end of the day, you gotta go with your base case scenario and what do you think it's worth today and where do you think it's headed. Not to say that obviously we could get in a situation where the grid goes down or whatever, and that's going to have that's going to show up in pricing. But at the end of the day, I think you got to kind of if you focus too much on these black swan events, I don't think you'd ever do anything from an investment standpoint.
Gotcha. And that's kind of what I've been focusing on lately with the whole reliability standpoint. I have a background in the industrial electrical systems, but I'm thinking more of the reliability that's going to be needed for this new digital infrastructure and the power grid. And so that's kind of what I've been working on this one project called a verified reliability layer for digital assets. But that's not what this episode is about. But
That's
but
the
I will
next
be.
episode.
I'm hoping I have a demo here soon. This coding is taking a lot more. I give coders way more respect than I ever did before. I didn't know. I never jumped into it, but now I understand how intricate and how my God, this it's a lot harder than I thought. But it's fun as well. I like to learn new things. So, but let me get back on subject. Mike, I want to bring this back to the everyday investor because a lot of people are trying to navigate a world that feels like it's changing faster than ever, right? They're hearing about AI and crypto and interest rates, inflation, tokenization, energy demand, supply chains, and infrastructure. Markets are hitting highs. I hear there's a lot of recession fears out there, especially with this whole new technology, right? And it can be overwhelming. What do retail investors most misunderstand about how capital actually moves?
Well, I think we're in a pretty unique time where if you want to be extremely bullish and positive, I think there's a lot of data points that you can point to. And I think at the same time, if you want to be bearish and really concerned, there's a lot of data points that you can point to. That's why whatever your strategy is or your plan is for me, it's looking at earnings and that will dictate ultimately where stocks are headed. You know, stocks aren't cheap right now. There's no doubt about that. The economy continues to grow, which is good. But I think for anyone out there, it's coming up with their strategy, what they're comfortable with. You know, obviously markets are cyclical. We haven't had a significant pullback for a long time.
Yeah.
Could we go into a recession? Absolutely. Will that start to show up in earnings? Absolutely. So I think trying to get in front of trends can be very difficult because it's going to show up. You're not going to get in front of it, but you're going to start to see if we go into a recession, you'll start to see S&P 500 earnings come down. And so I think that for me, that's one of the best statistics out there because you've got actual data. So you're not going to get in front of it. You know, a lot of times these trends go on for longer than people anticipate. You know, just because the market is hitting all-time highs, it's not typically a comfortable spot for people to put capital. But if you look historically, it's actually been a pretty effective strategy because, um, you know, these things continue to typically continue to move higher.
Great. And I want to hit you with one last question, Mike. Hopefully, that don't make it too hard. But how should investors think about innovation without turning every new theme into a trade?
Yeah, I think you know the biggest thing is you've got to have discipline and you've got to have your strategy. Um, Once again, I think retirement assets and things like that, that's longer term money that people really shouldn't take a ton of risk with. If you look at the S&P 500, historically it's gone up, right? And I think ultimately, once again, I know I've said it 100 times, but earnings drive stock prices, but you really do have to stay invested for your long-term money for the long term. And then if you've got a trading account, you can kind of do whatever you want with that, as long as you've got a plan and a strategy in place.
Mike, it's definitely good that you repeat it for the audience so they really understand. Because a lot of people just look at price and charts, and that's their investing. I hear this is going up, that's where I'm putting my money. But it's really it makes you're hitting the nail right on the head. Is strategy and how, like you're saying, your strategy. Hey, I like to look at the earnings, how I'm doing things, but that just shows, hey, whenever I'm looking at any of this, I'm sticking to my strategy. Mike, for everyday investors watching the financial world change quickly, AI, digital assets, tokenization, inflation, interest rates, energy, infrastructure, and all these new systems coming together, what is one piece of advice you would give them?
Yeah, there's always going to be a lot of noise out there, and there's no doubt that the world's changing rapidly with all the new technology that's going on. What I would say is that you want to stay diversified within your portfolio, and that means from a individual equity position or anything that's in the portfolio, you don't want to get too concentrated. And at the end of the day, you want to make sure that your long-term financial obligations are taken care of, right? So you want to have realistic expectations on the assets that you have currently in place and what you're going to need going forward. And that comes down to the individual. And that's the most important thing is to make sure that you're taken care of and that you're saving enough for the long term.
That was great, Mike. Thank you. I appreciate you coming and sharing your perspective. This conversation wasn't about hype, predictions, or chasing the next headline. If we're going to talk about a new financial world, we also have to understand how capital evaluates change. Not every new technology becomes an investment, not every trend belongs in a portfolio, and not every opportunity is ready just because the market is excited about it. And that's what this conversation brought back to the center. Strategy, risk management, valuation, diversification, and the patience to separate signals from noise. Mike, I really appreciate your time and your insight today. Thank you.
Yeah, man, I appreciate you having me on. So.
That wraps up this episode of the New Financial World Powering Tomorrow. Today's conversation gave us a ground look at how disciplined capital thinks about innovation. From AI and digital assets to tokenization, infrastructure, energy demand, and the physical systems underneath digital growth. Because the future of finance won't be built on hype alone. It will be built on systems, rules, risk management, real infrastructure, and capital that understands the difference between a trend and a real investment. So if this episode helped you think more clearly about where finance, technology, and infrastructure are heading, share it with someone who's trying to separate signal from noise. Until next time, learn, adapt, prosper. And as always, stay energized.